Hi guys, welcome to Trading in Zones. I've had a lot of people reaching out to me with a lot of indicators they get to use over a period of time. I'm sure a lot of you have been trading, and one of the most favorite indicators of for a lot of people, what I've heard and what I've seen is they tend to use RSI. When I started exploring RSI and when I heard RSI being used by a lot of folks, I really didn't know what it was and how it worked and what RSI was. And most of us, we have just been told one thing, it reaches 70, it's overbought, it reaches 30, it's oversold. So you can go and buy a stock, if it is reaching 30, and some people edit that to 80 and 20, and then there are a lot of strategies and videos which are being shared. But eventually, when you actually go back and ask any of these folks in terms of how does RSI actually work and what does RSI mean, I mean, who got RSI in first place? I mean, what was the need for RSI to be there in first place, and how is it actually telling me something about a stock? So, not many people really have these answers, but I've put in some effort as part of educating folks who are blindly using a lot of these things without really understanding how they work. So I thought today we'll spend some time and understand how RSI is actually working. So I'll pick up a stock to give you an example as well. I will pick up SBI um, as a stock, and let's look at SBI. You can ignore the indicator what I've placed at the bottom. I'll insert RSI. uh, Give me a moment as I load this up. I've just marked these levels for intraday. Let me hide them to avoid any kind of confusion. I'll also change the chart to a daily chart so that it becomes much easy while I'm trying to explain what happens to RSI. So RSI technically, you know, will probably give you some history so that you understand what RSI is and where it comes from. So when you can just Google relative strength index, you'll get a fair idea. This was developed by Wallace Wilder, relative strength index, momentum oscillator that measures the speed and change of price movements. So RSI oscillates between 0 and 100. Traditionally, according to Wilder, RSI is considered overbought above 70 and oversold below 30, and this is where most of the knowledge of people end because they don't go beyond this. They go and start preaching, saying that okay, this is how RSI works, and they never try to really understand, should I really make a trading decision just by knowing something is at overbought and oversold? Uh, is the stock continuing to fall? Can it go to a zero, and can it go to a 100? Can it really cross a 80 or 90? Or should I just go and short a stock just because it is at 70? So that question hangs on the mind, and if you are someone like me who has experimented a lot on these indicators and eventually lost money as well as made money, I wouldn't blame any of them who have trained me. I'm sure they tried their level best to educate me to the level where I've reached. They built enough inquisitiveness in me to go ahead go ahead and explore in terms of how things work. So RSI has a lot more attached to it, which will make you think before you actually use it. So if you see the calculation of RSI, this 100 minus 100 1 by RS is typically a smoothing component being added so that it gets into an index mode where it will not go into negative numbers. I'll tell you why. Because RSI is actually looking at average gain divided by average loss. Now, if you ask me, how how is that calculated? So I'll probably show you on an Excel sheet. You can get a lot of these Excel sheets online as well if you're interested. So RSI is typically calculated over a period of 14 days. So now if you look at 14 days, these are the closing prices of any stock. You can just pick any stock. You can put the closing prices of these stocks. So the first stock obviously has no difference, and the next stock has a difference, which is typically the difference between these two values. So we are saying that there is a change between this, which is a negative change. So the stock closed at 44.34, but the next day, it actually went down. Then it came back up, went down, and then it's been on an uptrend. Went down, uptrend, went down, uptrend. So on a daily basis, there are certain differences, and then there is a gain versus a loss being calculated. The days where there has been a gain and the days where there's been a negative trend, or rather than saying a negative trend, it closed lower than the previous day, to be precise. So RSI is technically, trying to consider this, and now if you go back to the formula, it looks at average gain divided by average loss. So that's exactly what the RS does. So you have the average gain of all these days, then you have the average loss of the previous 14 days, which gives you the RS value. Now, the remaining is more looked at from a smoothing percent. So this is, kind of technically converting this into a value. So what this says is, if I had no loss at all, if I probably take this off, these values off one by one, uh, what the RSI is going to do is, you can see that this RSI has started increasing to 84. So what it means is, if the stock has no negative value in terms of closing, it continues to increase and it can go up to 100%. So if there is no negative number at all over a period of 14 days, that means a stock is very much on a strong up move. Now, how can we interpret this numbers? How do we look at something which is consistently gaining, something which is consistently moving down? Some of these stocks might have good amount of volumes, which might be a typical case, or there might be some good news coming on a stock which is making it move up higher on a daily basis. A small stock which is of say 100 rupees per stock or 150 rupees per stock, on an average closing by a percent or two up on a daily basis, is a big move. So there might be something cooking on that stock, and RSI tells you that. So that is how you interpret RSI. This is the basic calculation behind RSI. Now, when you come back and when you go back to your chart, and when you really look at the chart, what you see here is like a divergence. You see that RSI did come down, right, at a certain price. Now, when you mark down, let's just draw a line, because this seems to be a strong support at this particular price point here. So let me draw a line. Oops, this is a manual line. Let me just take a horizontal line. Uh, so I'll go pick up the horizontal line, and I see that the candlestick seems to take a strong support at this level, and you can see the candlesticks here are taking the support as well. Let me remove the ones which are on top. Just give me a minute, so that it brings you certain clarity in terms of how and what kind of intelligence that RSI gives you, and how you can actually snap a divergence on RSI. So we see SBI has been consistent stock which has been falling on a daily basis, and you can see that RSI pretty much is also telling me the same thing. So the question might be, how do I really go and buy, at an oversold level? So if someone really went on and bought it on this particular day thinking RSI is, you know, oversold, so I'm gonna go and buy this because I expect this to move up, and I'll hold it. That's a complete incorrect strategy, because you can see on 1st of March RSI is at around 30, and the price action very clearly says that this was around 266. Maybe while closing, this was around 262. So now if you see, you have been holding the stock as long as you want. This has reached an RSI of 267 as of 28th of May, and what have you made? Like 3 rupees, 4 rupees? I mean, and how long have you been holding? And people go and say this is a swing strategy, go and use RSI. To be honest, most of these guys who are online making YouTube videos are, they don't even know what RSI is. They don't even know how it works. And if something's been in a downtrend, do you really know where it stops? Do you know whether this is really a retrace? And do you know that this is going to retrace back up to X? No one knows. It's only big players who move the market. They decide where to go, what prices are, and we are retail traders. We don't know what is going to happen with pricing most of the time. So you wait, you see a retrace, and then it starts coming back down again. But what you start seeing is RSI does make some divergence. So let's see what's happening at the same price level. When it came down to 232, there are two lows which it has made, and then it starts reversing, and then it holds the price. So when do I really buy, and when do I really trust that there is a divergence? So you can simply look at the RSI divergence here, uh, and then you can look at the RSI divergence once more. So what is it saying? It's saying that it's falling down. It's come down close to 30, but it's not gone as below as 23, which happened on 23rd of March. But what's the difference here? The price is the same. So the strength is actually increased in buying at the same price point when compared to what was happening on 23rd to compared to what was happening on 26th. So there is a significant difference here. So I would technically look at this closing, these two closings, as a strong closing, because I see RSI moving up, and then boom, what happens? The next day it opens gap up. So there is strength, and it comes down, but again when you see the price, it's around 238. But again, the RSI closing is very strong. So that means the last 14-day period, there are more positive numbers than the negative numbers. There are very few closes which are happening in a negative basis compared to the number of positives. There are more negative closing which is happening for RSI compared to what was happening somewhere over here. But if the difference between the closing of being positive and being negative, because we are taking average, so the stronger the negative closing is, the sharper the RSI falls. But you can see the candlesticks are much smaller. Though there is a fall, the fall has not really calculated the RSI really pushing down, because this time the fall is not big. But here the fall is really big in the last 14-day period, because the closing difference between the previous day and this day is huge. So here there is someone who's buying it at each level as it is coming down, and they're not really letting the price go down. So there is a significant amount of accumulation happening as per RSI, and that's exactly what RSI is telling me. It's telling me that though this is all negative bias, on the calculator, when you put these values here, you will see more red. Alright, you will not see much of green, but if you see the RSI value on the chart, it makes a significant difference because the RSI actually didn't go below 31, wherein it did go below 30 on the 23rd. And if you see, the price is exactly the same. So one, you look at the price action support. Two, you look at how significant is the RSI, how big is this closing from this closing. How big is the difference between this closing, this closing, this closing? There are bigger falls here. See the price difference. This was at 279, and if you calculate a 14-day period maybe till here, it's become 234, which is a huge fall. When compared to this one, which is a 262, and this has come down to 232, which is a much smaller fall. So RSI is actually giving you a divergence, saying that it's come down, bottoming at the same level, but this time the selling is not that big. The selling pressure has significantly reduced, and then you see a big price, you see a big move. So there is a big buyer who's sitting at this price, which is a very evident because this price is being protected and SBI is not going below this price. So this is where you need to be investing. This is where you need to be putting your money, saying that okay, I'm gonna invest on my swing, positional, however you look at, if you're doing an investment, you need to know how to read the balance statement. But if you're not the one, you just probably want to make money in a week or two, you want to know where exactly and what is happening with SBI. If it was me, I would have put my money right in here. Uh, Trading comes with a lot of risk, right? I need to keep my stop loss. I can't blindly say that, okay, I'm going to buy at this price and I will live at this price. So what am I looking at? When I go back and look at historical data as old as 2017 October, it's never made this low. It's actually rebounded back up. So it's broken that zone. So it's a little risky. So do I really want to invest here? On the first one, no, because there might be a fall again. On the second one, yes, I'll start thinking because there is a big buyer here, he's not letting this price go. And this could be something which is coming from a historical data trend, and we can look at that data trend as well. And we can see here there is a big buyer, and there was a big volume push which has happened sometime in the month of it says 8/11, so it's US. You can say this is sometime August 2016. So August 2016, there is some big buying, so there is some amount of price protection here. So my stop loss would be around, depending on how much my position sizing is and how much of risk I'm willing to take, maybe 1 to 2% for a 200 rupees stock expecting a 5% up move is a good risk ratio. So I usually look at 1:2, 1:1 for swings. So if I am doing a 2% stop loss, then I would look at least a 2% benefit to 4% benefit, or if I'm lucky, I'll trail the stop loss till I get maximum benefit. So in this situation, we can see that this has yielded very good results. 26th of April, if anyone has put money, or even rather, when it made one more low and RSI gave another divergence to us on the 17th of May, this was still a good investment. So 17th or 18th, if you're uh, putting in your money on SBI because it is closing strongly, RSI is showing it is making lower lows. You put in your money sometime on 25th, 244, you keep a stop loss, maybe at around 240 on a closing basis, and you let your money run, and if it goes in your direction like this, it goes in your direction, and you make a lot of money. So this is one of the strategies which is significantly used in terms of reading and interpreting RSI. But keep in mind, there is nothing called as oversold or overbought. The market is on its own. It can go way beyond 70, it can go way beyond 30. You keep 80, 20, it really doesn't matter. It's just a simple math. If a stock continues to fall and make lower low on a closing basis every single day, the RSI calculation is as simple as I showed you, right? And it is going to continue to plot a graph which is going to show that the stock is on a downtrend on a daily basis. So whether you use RSI on a 15-minute chart or a 5-minute chart, or you use RSI for a longer period of time for investment or swings or anything, keep in mind the base calculation is basically, it is giving you a number, it is showing you a direction of the trend on a closing basis. So there are a lot of softwares which gives you an option to change settings on RSI. There are people who use RSI 9, 6. The shorter the time frame, the faster the RSI calculation is, because it does not consider 14 days, it considers 9 days. So the last 9 days movement becomes bigger. You are someone who likes to probably look at last 5 days or last 3 days. You can edit an RSI to have last 3 day trend, and look at whether the stock is bullish the last 3 days, and you can make a stock selection. Excuse me. So you can make a stock selection based on what the RSI value is for the last 3 days. There are a lot of scanners which are available for free. You can go scan stocks based on RSI, pick up those stocks. You can do intraday swing, or you can use it for scalping. It depends on your trading style, how and what you want to do. But that's exactly how RSI works, and that's what I wanted to kind of educate all of you in terms of understanding how it does an average of the R and S, which is typically the gains and losses, and then it divides and gets a value, and then there is an index formula which is more of trying to get it into a percentage value, so that the values don't run into negatives which we will not be able to understand. Technically, when an RSI goes down to 0.61, knowing the math behind how RSI is calculated, it means that it is going down below or closer to 30. So the more the difference between the closing prices are, the more the negative numbers are, that means the stock is going down. And the higher the positive numbers are, that means the stock is actually moving up. And it's actually no rocket science. It's nothing like overbought or oversold. It's just an index over a period of 14 days. You can increase the index from 14 days to a 20-day, 30-day, or you can reduce it to a 10-day, 11-day, 9-day. You can do your slice and dice of the data, mix and match the analysis, and try and figure out. Thank you for being patient and listening to me.